Global bond funds have seen record inflows in 2024, driven by the highest yields in nearly 2 decades. This surge marks a strong recovery after a difficult 2022, positioning the bond market for a record-breaking year. Our next report telling you more.
Global bond funds have attracted a record $600 billion in inflows in 2024, marking a significant rebound from the $250 billion outflow seen in 2022. With bond yields reaching levels not seen in nearly 2 decades, investors have seized the opportunity, particularly in a climate of slowing inflation and lower interest rates. According to financial data provider EPFR, by mid-December, total bond inflows had surpassed $617 billion, outpacing the previous record of $500 billion set in 2021. This surge reflects growing confidence in fixed income investments as yields topped 4.5% last year, the highest since 2008. The bond market's strong performance has been largely driven by corporate bonds, which offer higher yields compared to government debt. As central banks reduced interest rates, corporate bonds rallied, aided by companies' ability to lock in long-term funding before borrowing costs rose. Passive exchange-traded funds, or ETFs, have played a pivotal role, attracting a record $350 billion by November, with giants like BlackRock and Vanguard reaping substantial inflow. These ETFs provide investors with easier access to the bond market, especially corporate bonds that are typically harder to trade. Despite the strong performance, there are signs that bond inflows may slow down in 2025. With the rise in US stock prices partly fueled by expectations surrounding President-elect Donald Trump's tax cuts and deregulation plans, equity markets have drawn considerable attention, reducing the relative appeal of bonds. Additionally, investors are skeptical that corporate bond yields can tighten further after this year's strong gains. Nevertheless, the bond market's performance in 2024 sets a strong precedent, driven by higher yields, central bank policies, and strategic investments in passive ETFs. Business Bureau WION World is One.
And well, for more on this, we're now being joined by Dr. Andrew Frere. He is the CEO of Ecognosis Advisory Limited. Welcome to World Business Watch.
Hello.
Hi. Now, with the FRD's hawkish tone for next year, what's your outlook for bonds in 2025?
Basically, it's going to be a very difficult year for a number of reasons. First, number one, Fed is clearly missing out completely its inflation target, and therefore it is unlikely to carry on cutting interest rates. They have already indicated that they will be cutting only by about twice in the first half of next year. Actually, I believe they will not even do that because inflation will continue to outplay them completely, which means that prices of bonds cannot be expected to carry on increasing. They are still at a substantial level of yields. If in fact American 2 and 10 years are yielding 4%, which is an exceptionally high yield compared, for example, to what's happening in the European bonds. Number one. Number two is this Trump's tariff policies are going to kick inflation in, but it's going to be a once-off. Now, the markets are unlikely to simply swallow this as a one-off, and they will continue to assume that inflation is not going to be controlled. And that means, of course, that the news are bad as far as further declines in bond yields, and of course, even worse news as far as equities are concerned, which means that next year is going to be a difficult year for bonds and an even worse year for equities.
Right. Dr. Frere, what does the Fed's few rate cut next year mean to the emerging markets?
Absolutely nothing, because emerging markets is not emerging markets, are individual countries. If I was to take the fourth, or rather correctly, the second biggest economy in the world, and that is China, Chinese interest rates are falling and they will continue to fall. So now, even if the Fed decides not to cut any further, this will have zilch effect on China's monetary policy. Or even if the Fed decided to increase for that matter, this will have zilch effects on China's monetary policy. The same thing goes for Japan, where there has been an ambivalence whether the inflationary expectations are likely to stop the Bank of Japan of cutting interest rates as quickly as they had hoped to do. So it is a very messy picture, but we have to remove continuously the idea that whatever happens in the Fed is going to affect at least the very big markets. But then, of course, in the case of Hong Kong, whatever happens to Fed happens to Hong Kong. And then Hong Kong is, of course, pegged to the US dollar. So I'm afraid I cannot give you a broad answer. Depends.
Right, Dr. Freris. I also want to talk about the Indian bonds, which have seen steady inflows this year after the inclusion in global indices. Perhaps what does 2025 hold for the Indian bonds?
This, of course, is going to depend on how the newly refurbished central bank in India with a new governor is going to do as far as interest rates are concerned. And that, of course, reflects directly on inflation. Again, it is likely to play out as long as inflation does not accelerate or does not move away from the trend, then the Reserve Bank of India will have space to cut interest rates irrespective of what happened to the States. This is a completely domestic decision.
Right, Dr. Freris, my last question to you. With the dollar expected to reign supreme, what can emerging markets' central banks do to keep their currencies stable?
They do absolutely nothing. I'm afraid I have decided decades ago that it is complete nonsense to claim that Asian central banks have got a US dollar policy. And if the US dollar does this or the other, they will do that simultaneously. They have their own domestic policies, which reflect, of course, their rates of inflation. Now, if the Fed strengthens and therefore they weaken, you could say this is good as far as exports are concerned and vice versa. But the role of inflation will continue to be quite important. And in certain cases, like in the case of South Korea, where both the mixture of inflation, exports, the exports to the United States is now playing out completely because of the political crisis that reflects a completely different set of issues. So I'm afraid I wish I could give you a good answer on emerging markets, exchange rates, and the US dollar, but I'm afraid there isn't any, as far as I'm concerned. Depends. Sorry, I sound like an economist, and I hate that.
Right, Dr. Freris, but thank you so much for joining us on World Business Watch with your insights on this.
Thank you.